I'd like to welcome everyone to Maine's podcast for July 29th, 2025, entitled Workforce Housing, a Niche Opportunity with Strong Demand. To guide us through this very timely and important topic, we're joined by two experienced and successful professional investors who will offer their views on how this opportunity can be effectively navigated and managed. Amy Rubenstein, CEO of Clear Investment Group, and Jordan Dickman, Managing Director of Investments with Marcus Millichap. And I'm Robert Akeson, President of Maine and the moderator. And for those of you who don't know Maine well enough, we're a trade association and networking group that focuses on the needs of startup, small, and emerging asset managers, both hedge funds and registered investment advisors, as well as public and private digital issuers and the ecosystems that support them. We are committed to bringing high value, low cost content and networking and business opportunities to these market participants. And we're very interested in what our members and audience thinks so we can make our programming as relevant as possible. For those of you who want to start and grow a money management firm, Maine is the right place to be. Now, before we start, I do want to thank our sponsors, and you can see on this very busy page, we have 11 of them, including Blank Rome, BW Cyber, Citron Cooperman, CRC, Concertive, DMA, Fox Rothschilds, Marex, Miri Asset Securities, PFK O'Connor Davies, and Solidus Advisors. Now let's meet our panelists. Amy Rubenstein, CEO of Clear Investment Group, has built an impressive track record of acquiring distressed or undervalued workforce housing properties below replacement costs, restoring them to safe, attractive living standards, and delivering long-term capital growth while addressing a pressing national need. Over her 22-plus year career, she has delivered a 37% net IRR to her investors. Amy Rubenstein, welcome to Maine.
Thank you.
Joining Amy, great to have you. Joining Amy is Jordan Dickman, Managing Director of Investments with Marcus and Millichap, whose investment-driven approach has helped reshape multifamily strategies at the firm. Jordan is focused on ensuring clients preserve wealth and unlock long-term value through smart transaction guidance. Together, Amy and Jordan offer a dual lens view into today's multifamily landscape, combining successful execution and deep market insight. Welcome, Jordan Dickman. Now, just a reminder to everyone in our audience, our panelists will be answering my questions for approximately 45 to 50 minutes. We'll then open it up to the audience. However, if at any time you have a question, by all means, please use the tools at the lower right-hand corner to send me the questions. So, okay, let's get to it. How would you define workforce housing, and how does it differ from traditional multifamily or affordable housing? And Jordan, I'm going to ask you to take us out on this.
Yeah, appreciate it. Workforce housing off the cusp to a lot of people generally means affordable housing, and I think that's where there's sometimes some confusion in what it really is. But it's really the backbone of society as far as we're concerned in what we do. It's renters by necessity versus renters by lifestyle. So it's your teachers, it's your nurses, it's your factory workers. It's generally 80% of the population in your city that are living in apartments, generally out of necessity for a place to live. They're not really your home buyers. They were brought up in apartments, and it's a place for them to live. So, it's different because it does not have subsidies generally. There's no government tax subsidies. Unlike, luxury product, it doesn't have amenities. It's generally older style construction, which means it's a little bit more affordable to the everyday working person.
Thank you, Jordan. Amy, would you like to add?
That was a pretty good definition.
All right.
I would say when we're looking at workforce housing, we describe it exactly the same way. Specifically, we look at an annual household income somewhere between $35,000 and $85,000 a year, depending on the market.
Okay, thank you. So, how does how has broader distress or dislocation in multifamily affected workforce housing? I mean, let's get specific about that. Jordan, why don't you take a stab at that, please?
Well, so I would say a lot of the distress that we actually see in the workforce housing market comes from the capital stack. It doesn't generally come from the underlying fundamentals of the product itself. A lot of the distress that we're seeing today is from over-leveraged assets, inexperienced operators, over-leveraged with preferred equity, et cetera, and they didn't stack the deal up properly when they purchased it. From a fundamental standpoint in workforce housing, you're looking at extremely strong occupancies, especially in supply-constrained markets like the Midwest. You're not seeing the bad debt issues. You're still seeing low and modest rent growth in most of the markets. So just, again, to recap that, I mean, there's not a ton of distress or dislocation in workforce housing or in multifamily from a fundamental deal operations perspective. Most of it ends up in the capital stack from inexperienced operators that, quite frankly, probably shouldn't have gotten in the market 3 or 4 years ago.
Okay, thanks, Jordan. Amy, any thoughts on that?
Yeah, and we generally say that the distress often comes from a distressed seller. And that distress, while it doesn't exist in the asset class itself as a whole, it can start to exist in the asset itself and manifest itself with high vacancies, high delinquencies, maybe a little bit of crime, some deferred maintenance. Those are the things that we start to see, but the cause of it is usually because the seller has some personal distress or distress within their own company that then trickles down.
Sure. So I think both of you seem to agree that demand for this type of housing is quite solid, quite robust, in fact. And so, the question I think maybe folks in the audience might be mulling over at this point is: are there any mispricings or overlooked opportunities in workforce housing that investors should be paying attention to at this time? Amy, why don't you take a shot at that?
Sure. I mean, we tend to think that there's distress to buy in any market. When it's a seller's market, when it's a buyer's market, there's always some sort of distressed deal around. I think there are certain times where you start to see more. It happens to be a pretty good time right now to buy distress. And that's because there are some forces that pushed sellers over the edge. So typically, like Jordan said, you'll get a seller that maybe shouldn't have gotten into the particular asset that they're into, as far maybe they didn't have the experience for operating it, and then something sort of pushed them over the edge. A lot of people that we're seeing right now that have distressed assets started to feel distressed during COVID. Maybe they didn't handle that section, that part,
Okay.
that particular time period very well, and then that was like the instigator of their distress, and then something else continued to happen. Interest rates then rose, and so that pushed them over the edge
Yes.
more. And it's possible then that you have some people that were buying, so that's like that vintage of prior to COVID, right? And then
Yes.
you've got that vintage of assets that were purchased in 2021, 22, when the market was a little bit more robust, and people were paying a little bit higher prices at that point, and then didn't know how to operate, and so therefore their capital stack gets a little out of whack, like Jordan was saying. So those are kind of the different things that we see right now, but there's always something that causes it.
Yes. Thank you, Amy. And Jordan, what is your view on mispricings or overlooked opportunities at this point?
Yeah, I mean, I think Amy nailed it with distress, so I won't go into that. Going to something else, some of these smaller markets outside of the major metros, we're seeing a lot of opportunity in mispricing. The workforce housing, tenant demographic is willing to drive a little bit further as of late, and we're seeing a little bit more of a suburban sprawl into a lot of these markets. And so, we are seeing a lot of opportunity in these smaller markets outside of some of the major metros, where there's lower market rents. There's a large demand for housing in the area, maybe can't build a new single family home because they can't sell it on the back end. And so from a from a location perspective, there are other opportunities right now that are leading to mispricing, and I think it's a great opportunity to take advantage of. The only other thing I will say is as a whole, there's a huge potential in mispricing in workforce housing as it is. We'll talk about it more later, and I'm not going to go into it now, but there is a move away from some of the older product right now from operators and equity, which has created a huge void and a huge potential opportunity in workforce housing as a whole.
Okay, and Jordan, let me follow up with you on this. How has renter behavior changed in Class B and C housing recently? And what does that mean for long-term stability, Jordan?
Yeah, so I think sort of partitioning off of what I just mentioned, we're seeing tenants that are willing to move a little bit further for a place to live. It's become a lot more difficult to qualify for an FHA loan to buy a home. So we're seeing lower turnover in a lot of these apartment complexes. We're seeing people that are looking for a place that's managed as though it's a home, and they're looking for an opportunity that is more of a home versus a rental product, and that can be achieved through a well-maintained asset. So a lot of these people are traveling a little bit further to live than right next to their job. I mean, in, Midwest, even Southeast, I mean, you can get, 15, 20 minutes, you can go a long way. So there's a much larger net to be cast on workforce housing and the potential opportunities in these markets, because you're getting more of a tenant demographic that's willing to travel for well-managed, good product.
Very interesting, very interesting. And Amy, what are your thoughts on renter behavior with respect to Class B and C housing?
Yeah, I mean, to kind of taking this in a little bit of a different direction, I think that there were some government subsidies that started coming out post-COVID that came out a little bit late when people
Okay.
kind of needed help during COVID, and the subsidies took so long to get rolled out that they started coming out post-COVID. So we went through a period of time where landlords weren't allowed to file evictions during the COVID period. And then we went through the period after that where people were getting subsidies. And I think that that sort of created a bit of a difficult situation for tenants because they kind of got trained not to prioritize rent
Okay.
expense. And so I think then we started to see a wave of evictions or delinquencies that maybe a lot of landlords weren't prepared for. And so that was a bit of the struggle of, I think, why some of the landlords started to have more distress in their portfolio. And now we're kind of working through that and getting out the other end. And I think we're getting past that. But it did take a bit of an adjustment period. And so I think that that also caused a lot of distress opportunity. Or I hate to use the word opportunity there, but distress in general for people to kind of step in, because we did have to kind of orient tenants to focusing on rent payments as a priority again.
I see. And Amy, let me just follow up with you on that and with the following. What submarkets or regions are proven to be especially resilient or opportunistic from a workforce housing investment standpoint? What do you think, Amy?
Overall, we have seen workforce housing be resilient as far as rent growth. And we have not seen that rent decrease that some of the A-class markets are seeing. And I guess when I say A-class market, I'm saying within a market, the A-class assets are getting some decreases of rents where we're still getting increases of rents in workforce housing. So that continues to grow. And again, like Jordan said, fundamentals of workforce housing are super strong and have stayed really strong. We've had some hurdles to go through, but not as far as rent growth right now. And so we're seeing it all over the place. We love the Midwest. We love some of the smaller markets that are outside of the bigger cities. But there's a lot of growth all over the place right now.
Very interesting. And Jordan, what are your views on this? What
Yeah.
submarkets or regions are more or less opportunistic and resilient at this point?
Yeah, but I would agree with Amy. I mean, most of our business, pretty much all of our business is throughout the Midwest. And so I would say most of our markets have been extremely resilient. And actually, a lot of the rental growth that we've seen over the past 3 and 5 years, you look at like a Cincinnati or Dayton, who have been at the top of rental growth in the market, it's come from the workforce housing realm. It's, a lot of these markets, you're not looking at the A class that's leading the rental growth year over year. You're looking at the workforce housing market that's actually providing a lot of the rental growth in the market and the opportunity. So again, I said it at the beginning, you look at markets in the Midwest, it's the backbone of our city. I mean, 75% of the product is pre-1980s. I mean, it is the lifeblood of what the market is, and it's what provides the stability. The luxury Class A housing is where sometimes you see the vacancy of the absorption issues. You don't see those types of problems in the workforce housing because, again, it's living out of necessity. These people don't have anywhere else to go. Luxury, you're buying homes, you're moving to other areas, but here, this is what these people need. It's their livelihood. So it's very, very resilient, especially in most of the markets we work. And I know Amy's in a lot of other markets throughout the Southeast where it's extremely resilient as well.
Okay,
But Jordan
thank you,
makes a
Jordan.
really good point, because you get some markets that have been overbuilt with growth, but that overbuilding is very specific. We're talking about newer development, and it's an A and B asset class. It's not that C asset class or that workforce housing. And so even when you see markets get overheated, like in Atlanta or in Austin or in Nashville, you might feel a little bit of that extra vacancy rate in your workforce housing, but not nearly what you're going to get in that new development.
Interesting, interesting. And so, Amy, what economic or demographic trends are driving this increased demand for workforce housing?
It's really that there's a lack of the new workforce housing coming on the market, and then you get some deterioration of some existing workforce housing.
Okay.
And so therefore, you're getting an increase of, especially when you go through periods of like recession or inflation, you get a higher demand for workforce housing, and we have a lower supply than ever. And that supply is not going to increase, especially when you have an administration right now, like we do, where you're not getting subsidies towards building new affordable housing.
Yes.
And even if you were, you're competing against a little bit of a different, subsidized housing is a little bit different than what we're talking about, which is naturally affordable housing or market rate housing. And so when we're buying, when we're trading deals, so when I buy far below the cost of replacement of a new deal. And even when I sell, I'm selling below the cost of replacement. And I think that's what Jordan's seeing a lot of that too, is most of the deals trading, when you're talking about prior to 1980s properties, you're buying and selling assets that are being bought and sold below what it would be to replace them with something new. And so therefore, new assets can't really compete with our rents. And so that's why the demand stays so strong with this asset class.
I see. I see. And Jordan, what are your thoughts on the economic and demographic trends here?
Amy nailed it. I think the only other thing to say is just that it's become extremely difficult for, workforce housing tenants to qualify to purchase a new home. And so where, maybe 4, 5, 6 years ago, we were losing, some tenants to new home ownership, the amount of tenants that you're losing to new home ownership anymore is dwindled down to almost zero. And so, your demand for that is going through the roof because the supply continues to increase of more people entering into that sort of workforce housing realm, and you don't have anybody leaving to go buy homes anymore. And so it's created this very large demand for that type of product. And as Amy said, you're not building any new, C plus, B minus C product. You just can't afford to do it. And we don't compete with, any of the subsidized housing. So, limited supply of housing and just a continued increase of demand.
Now, Jordan, I think it's fair to say that you've seen some good and bad transactions over your time in the business. So let me ask you, how are buyers getting deals done right now, and what's changed?
Experience, is the only way to get a deal done in today's market. Oftentimes, banks and lenders are underwriting the operator harder than they're even underwriting the deal right now. And so, the relationships and the experience that the buyer can bring to the table are the only thing that are getting a deal done today. Whether that's, experience through, CapEx issues in the past, understanding the insurance market, the debt market. I mean, the transactional market shifts, almost quarterly on us right now with new changes that continue to blow into us very quickly. And so having someone that is transacted in the current market, has relationships in the market are the only way you're getting a deal done. So heavily reliance on the track record right now.
Okay, very good. Amy, what are your thoughts on that?
Yeah, we're seeing the same things. We often will put out an offer on a property, and our offer is a bit disconnected from what the seller wants to achieve. And so the seller will end up going with a higher offer on the property.
Okay.
And 8 to 10 months later, that seller is coming back to us because they had that deal tied up with a buyer who had a higher price on it, but that buyer didn't end up getting financed. And
Okay.
so because we've been doing this for so long, the same exact thing, we end up, we don't have troubles getting our capital stack in order. So meaning our equity is readily available and our debt is always comes along. The lenders know what we do. We've got that track record for being able to do it. And we do feel like we are definitely underwritten more than the asset itself. Because when you're talking about a distressed asset, if it's a distressed asset in particular, then you're not, the lender has to underwrite something else. They have to underwrite
Yes.
what is that deal going to look like at stabilization, and therefore they have to underwrite the ability to get it to stabilization. And so that's why we're able to take down a lot of these deals. It changes a bit when you start to buy stabilized assets. So if you're buying the stabilized assets, then there is more of an
Okay.
emphasis on that stabilized asset. But the lending market has shifted quite a bit in the last couple of years.
And Amy, just to follow up on that, what types of buyers are most active in this space today? And how has that shifted over the last, let's say, 12 to 24 months?
Uh, I think, in the last 24 months, we've definitely seen a pullback of transactions. So
Okay.
we, the market did turn to a buyer's market for sure.
Ah,
There just wasn't a ton going on. Now, I will say that we started to see a shift in that, and maybe Jordan can speak a little bit more to this, but come January 2025, we started to see transactions pick up a bit. Then I think it
okay.
slowed down a little bit once tariffs got announced and people were getting a little nervous about what the future is. And I think we're starting to feel people jump back into the game again. Jordan, are you
Okay.
seeing those same trends?
Jordan, what are
Definitely.
your
I
thoughts
mean,
here? Yeah.
yeah, yeah. It's funny because 24 months, institutional players put their pencils down, and then a lot of people follow in suit because they wonder if the large institutional players are stopping transactions. Should I be still transacting in the market? And so you really only got, the good operator, the good buyer with experience in the market that continued to transact over the last 24 months. The fly-by-night syndicators kind of fell off the wayside, et cetera.
Yes.
At the beginning of this year, Amy's right. Transactional volume kind of seemed to pick up a little bit because new regime in place.
Yeah.
Everything sort of pushing towards real estate being back as a great investment again. Tariffs jump in, everybody gets a little bit excited, starts to question what's going to happen next, how is this going to affect me, so they slow down. We're through some of that uncertainty now, and I would say for the last 2 months we've felt a huge pickup in transactional volume, whether that be BOVs, listings, deals under contract. It seems like the competitive nature is back out in the market. There's some really, really good tailwinds behind investors right now with some really big confidence in, where interest rates are going to move in the future, et cetera. So I expect to see a lot more players on the field through the end of the year as compared to what we saw earlier this year and over the last 24 months. But, for the last 24 months, it was only those that, had proven experience in that market. We didn't have a lot of new people breaking into new markets like we generally see. But I think in 6 months, if you ask us that question again, we're going to be going, it's a completely different field now. We're looking at a completely different scope of investors, and that'll probably change 6 months after that again. It's a very fast-paced environment right now.
And I think that's also being fueled quite a bit by a change in the lending market, where, in the last, I would say 12 to 24 months ago, we really had lenders, traditional lenders, bank lenders, really start to exit the market, or they stood on the sidelines and they were very,
Yes.
very discerning as to what they would lend on. The LTVs, the loan to values on their loans, really started to be reduced. And they wanted to just sit and watch what was happening. They were lending to more experienced buyers, and they were lending to more stabilized assets, but they wanted to sit on the sidelines. So that led this opportunity for this flood of private lenders to come into the market and start to really be competitive with more traditional banks, which I hadn't seen in decades. I haven't seen private lenders or private debt funds be as aggressive with lending as they were. So then what happened is banks started getting less and less deals. There was less competition between the two because now all of a sudden these private lenders started to be very competitive. And so then the banks, when they started to jump back into the market, which we've now seen really only in 2025 is when I've seen them start to come back in, just as of recent. What they had to do was decrease their spread. So even though interest rates didn't drop, we started to see higher volume of banks coming back into the game and coming back with lower spreads. So effectively, our interest rates did get reduced. So that is also what started to fuel some of these higher level transactions that we're starting to feel.
That's a very
It's
interesting
interesting you
insight.
say
Yes.
that. I know you're going to another question, but it's interesting you say that because that happened buyers and lenders alike, right? Everybody was expecting that the market was going to change next year. The market's going to change next year. And this was the first year that we came into where everybody realizes this is the market we're in. And if I'm going to make money, if I'm going to loan, if I'm going to make any transaction happen, I have to do it in the market we're in today because that's the market we're going to be in for the foreseeable future. And that even goes to Fannie Freddie, who are, tightening up their spreads to get deals done because they've been on the sidelines for 2 years, not hitting their expectations. So that's across the board. What Amy said is, it's completely true of, people no longer are waiting for next year because we're now working in the environment we're in today for the first time in 24 months.
So Jordan, let me just follow up with you on this then. Can you walk us through a recent workforce housing transaction and explain what made it compelling to the buyer?
So I have two quick ones I can go over that kind of talk about everything that we've just kind of gone through from a deal perspective scenario. We had 150 units that had 12-year ownership. Gentlemen that bought the deal for depreciation purposes, weren't generally multifamily operators, hadn't pushed rents in 5 years, took care of, roofs, gutters, downspouts. They took care of all the big deferred maintenance items, but, really no interior renovations, et cetera. Just owned the asset, depreciated it, left a lot of meat on the bone for the next incoming investor with market rents that were $350 below rent and an extremely clean property. So that's your right down the fairway, 10, 15-year owner that is extremely clean, that if Amy hears 300, 400 units of that, she's all over it, right? That's the greatest opportunity there is. And then, we've got another asset out there right now that goes to close in the next 3 weeks. It was a deal that was purchased through us 3 years ago. We sold it to the gentleman, opportunity to renovate. He bought it from a long-term owner. He was one of those, quote unquote spreadsheet operators I mentioned at the beginning. He missed the target on his renovations. He missed the target on what his renovation budget was, ended up running out of money about 40% of the way through the property. We're going to get him out of it clean. He'll make money, but he just completely missed the mark with the opportunity because he wasn't experienced in the area. He tried to vertically integrate his whole company. And so it's a great opportunity for somebody to come in, sort of pick up what that distressed mess is that Amy was mentioning that, they fell into. They're cash flowing, but they just did not implement the value strategy they thought they would. And so somebody else looks at that and says, I can finish this for a discount today, finish the potential, and execute on what his initial plan was. So sort of both spectrums, pre-COVID and post-COVID.
Sure.
A lot of potential out there from two extremely different ownership scenarios.
Okay. Thank you, Jordan. And Amy, how about you? Any recent transactions that you'd like to highlight here?
Yeah, we're always looking for kind of these odd and interesting stories, and it's really more about the actual seller than about the market itself. But we recently closed on about 700 units in Washington, D.C., and like I had said before, we often are looking at these deals or putting offers on these deals up to a year prior to when they actually go through. And so this was a deal that we had put an offer on a year prior. The
Sure.
seller was asking at the time $110 million for the asset. It went through bankruptcy court. There were a lot of parties involved in this. It got very, very complicated and needed buy-in from a lot of different creditors, from the city, from the courts, from the seller himself. We ended up closing the deal at about 54.5 million. And the deal did have a lot of distress from a management standpoint, as far as tenants not paying rent, and as far as some of the cosmetic issues at the property, but it wasn't a very physically distressed property, and it ended up being a fantastic deal for us. But a lot of the reason that we were able to take down a deal at such a low price was because everyone had to buy into the fact that we had that the buyer was going to have enough experience to handle the deal. And so there were so many people watching for that track record and that experience. And same thing on the loan side is we found that lenders were very skittish looking at a deal that had had so much of a troubled past. And so it took just the right combination of events to make that deal close.
So Amy, given all the hoops that you folks have to go through to get a deal done, right? And given your experience brokering, I suppose thousands of units, what separates the top operators in this segment from the rest? What do they do that distinguishes them?
A lot of these, I tell my team this all the time. I mean, there are always going to be, and these types of properties, if you're looking at a little bit of an older vintage, there's always going to be some sort of physical issue that you're working with. If you're working with lower income tenants, there's always going to be some problems that need some help solving. All of it can be tackled, but the thing is when you're dealt with 100 issues at one time, you could pick 10 of those that are valid, but aren't going to get you moving forward. And so you got to pick the right 10 issues to tackle first. And you got to start tackling them in the right order. Because while all the issues need to be dealt with, if they're dealt with in the wrong order, you could start to spiral downwards. So it's really the operators that are focused on what is going to get occupancy and collections up the fastest. And that's where that focus needs to really stay. If you start dealing with other things first, you're not going to get there. So we're always focused on occupancy first, collections first. And as we go through that, you have to deal with other issues to get there, but you got to have that in the forefront of your mind first.
Yes. And how about you, Jordan? What separates the top operators from the rest? What have you seen?
You just heard it from one of the top operators. I mean, it's blocking and tackling, right? It's presence in the deal and understanding that they need to have presence in the deal. And, coming from somebody like Amy who manages that many units, she knows the day in, day out of her deals. And the operators that understand that it's a daily task, it's not a weekly or a monthly check-in, are the ones that are the most successful. To have a team in place that can do daily meetings and daily check-ins and do the blocking and tackling is the biggest difference between those who fail and those who succeed.
Okay. And so, Jordan, a follow-up to you would be, how are the capital markets, especially interest rates and debt availability, shaping investor interest in this space at this time?
I mean, it's been the herd. I mean, it takes the track record and the discipline in the market to be able to transact, and so it's definitely been the herd of people that are interested in this market, not willing to pick up the shovel and start digging down into what the deal really is, and so it's created this huge opportunity for people to come in and make money in this space, but higher debt service coverage ratios, lower leverage deals. The capital market has made it a little bit less attractive over the last 12 to 24 months to invest in this realm, but that has slowly been reflected in pricing and created the opportunities and some of the opportunities that Amy's looking at right now, just because of what the capital market has done to the industry as a whole, not even just workforce housing. So it's been the herd. The strong have survived over the last 24 months, and I think there's a really good light at the end of the tunnel over the next 12 to 24 months for the right positioned operators to make some really good money moving forward.
Thank you, Jordan. And what about you, Amy? What are you thinking about market conditions, especially interest rates and debt availability at this point? How do you see this impacting the space?
Yeah, I don't know that we're going to get any interest rate cuts coming up. We try not to speculate for any change in interest rates. We generally are underwriting for a rise in interest rates, although today I don't know that you're going to get a rise in interest rates, but I wouldn't count on any cuts. I think what I think Jordan mentioned this before, but we're kind of settling into what a new normal is. And I think for the first time people are realizing there might not be a ton of movement coming up in interest rates themselves. So it's the confidence in the market to kind of get back in, the confidence of the lenders to get back in, and the buyers saying, all right, we're not going to sit on the sidelines anymore. We're ready to transact. We see that the fundamentals of multifamily and specifically of affordable multifamily are very, very strong right now. And so now we're ready to actually jump back in and then reap the benefits of those markets. And so I do think, like Jordan says, that we will see a pickup of transactions. And I think we're starting to feel it. We're hoping to continue to feel it. And everybody has to be creative as to how they wiggle their ways back in, which includes lenders and borrowers coming together and finding out ways that everyone can get comfortable with this new normal.
And Amy, to follow up with you, what type of financing do you typically prefer in the distress space?
So we really like traditional bank financing. It gives us the most flexibility. Our buyers, the best financing for our buyers, or for anyone who's looking for a little bit more of a longer term hold, like 5+ years, the best financing for them is going to be agency debt. So Fannie Freddie loans are going to be the best types of loans that you can get. You're still getting really good interest rates historically right now. And you can get better leverage than if you go with a traditional bank. For us, when we want that flexibility of being able to exit once we do our job. So we're taking properties that often are negative cash flowing or just breaking even, and we're adding so much to the NOI that now all of a sudden they're cash flowing. Now they're in a good position for agency debt. Now a buyer can take over, hold, and add value from there. But for us, we want that flexibility. And so that's why we are looking mostly at bank debt, but also at some private debt as well.
Okay, thank you. And Jordan, what about you? Any thoughts on this?
I would agree with it. Local, regional bank debt, private debt, really anything to bridge until you can get to that, Fannie, Freddie, agency, life co-execution. So we call it a bridge. You're just trying to find whatever avenue is best for that specific deal to bridge you to get there.
Okay. And let me just throw out a very generic question, but I think it begs worth being asked, and that is, why is workforce housing an especially attractive investment option right now? Why is it so attractive? Amy, what are your thoughts here?
For me, I look back over the last 20+ years and I see in the ups and the downs, workforce housing is what stayed the strongest. So when I first started out in this business, we did dabble in different asset classes. And when we went through our first downturn and our first upswing and then the second and then the third, we really liked the way that the affordable housing performed because, like Jordan said, we are dealing with renters by necessity. These renters are not choosing us over something else. This is the asset class that they are going to be in. And so therefore the demand is always going to be there. And so that's why we really like this asset class the most.
Okay, and let me just throw another question in here, directly from the audience. What are typical LTVs and lending rates?
So traditionally, we like to be at 70% loan to all-in cost.
Okay.
This is going to look a little bit different. That can look like an LTV, 70% LTV once stabilized.
All right.
But I would say right now, you're getting, lenders are trying to be closer to 65% LTV. That's what they're aiming for. And we have to do a little bit of, a little bit of painting the picture of where we're heading and making sure that the lender's really understanding what stabilization is going to look like in 12 months. And we're trying to get them to that place. But I would say 65% LTV is pretty normal today. And as far as interest rates, we definitely can be sub 7% right now.
Okay.
If you're agency, then you're in the lower range, hovering above 6%. And if you're more traditional bank, you're going to be closer to that 7%. If you're going private, you're probably going to be above that 70%. but your LTV is going to be higher. So you can probably push to 70, 75% LTV if you're going private debt, but you're paying a little bit more on your interest rate, but your returns are probably going to look pretty similar.
Okay,
Jordan, are you seeing
thank you.
anything different than that?
Jordan, any thoughts?
No, I mean, I've seen some agency at as low as 5.85, but generally 6%, and then private debt can go all the way up to 8%. So basically from 6 to 8%, and then like Amy said, 60, 65% generally on the low side for LTV, all the way up to 80% if you're willing to pay a higher interest rate and take some of that risk. So, yeah.
Okay, and so what are some of the critical underwriting criteria that you have on your checklist? Amy, what about you?
We are really looking towards what is pro forma going to be. Where are we going to be once we've stabilized the asset? We look very closely at where are we at today and what do we need to do to get to where we need to be.
Yes.
So we use that first number as a variable. For us, it doesn't matter if we're negative cash flowing on day one, if we're breaking even, if there's a little bit of cash flow. That number doesn't matter as far as whether or not we'll go into the deal. So we don't look at incoming cap rates, but we want to understand why the deal is where it is and what the deal needs to have happen to it to get it to the place of market stabilization. So when we talk about market stabilization, we're saying average rents for that area, average collections for that area, average occupancy for that area. That's where we're trying to get. And we're going to start there. And we want to understand how much time and money is it going to cost us to get from that initial point to where we want to go. So we're looking at like the reasons why people are not paying rent, the reasons why there's a lot of vacancy. And we're trying to really understand that, really understand how that compares to the market conditions. And once we fully understand that, then we can move forward on a deal. And that's what dictates how much we can pay for it.
Thank you, Amy. How about you, Jordan? What criteria do you typically look at?
Yeah, I mean, I guess if we're kind of cornering this to like workforce housing, potential, renovation, sort of light value add plays, et cetera. I mean, it's really based on stabilization, like Amy said. I mean, the deal always starts with what is it worth when it's complete. I will say the one big thing today is Amy said it earlier, but the seller and the story matters more than it ever has before. I mean, the market statistics of average rent and sort of where the asset sits today versus where it could sit is important, but the story behind where it's there is much more important today in a buyer's eyes as well as a lender's eyes, because, for too long, deals sold on the potential of a rental increase, and there's this opportunity, but nobody ever really knew what the opportunity was. So the deal story itself is just as important when we're underwriting these deals to get to that stabilized value. And it's a little bit more of an art because you're not just pointing to a number, you're not pointing to an average household income or the economics. You're having to really dig in and understand where did the deal go wrong and where is the real potential for the asset. And that's when it becomes a little bit more of an art than a science.
Yes, yes. And Jordan, let me just follow up with this. How do you see expected returns and risk profiles in workforce housing comparing to, let's say, core or luxury multifamily? How do you see the expected returns and risk profiles comparing across these different silos?
Return profiles are much higher for workforce housing. I mean, you're looking at, Amy hits the ball in the park on this, but generally when we underwrite a deal, we're at like 15 to 18% IRRs on like a workforce housing sort of repositioning play in the market. And that's generally what most of the market underwrites to. And if you can outpace that, you're doing a great job. Core luxury, is built a little bit more on cash flow, so they're less IRR driven, but it's going to be somewhere around that 6 to 8% stabilized throughout the asset. Okay. So it's interesting because, that's almost like pricing a bond, which is your luxury apartment would be like your bond scenario in real estate. And then, the workforce housing would maybe be a little bit of your riskier stock, right? Where you're getting some of those higher inflated returns. But, if you listen to everything we just talked about, the resiliency is in workforce housing. And so as far as I'm concerned, you're investing in the stronger of the product types, the necessity, the backbone of the market, and you're getting more than double the return. And so
what you're saying is the workforce housing demand is more inelastic. Is that an accurate statement?
Correct.
Okay.
Correct. And so all things considered, you should get a lower return for the stronger asset, but you get a better return for the workforce housing. You just have to have that operator in place that understands the product, that puts the time in and can execute on the business plan. And if you do have that, as far as I'm concerned, I don't think you're taking any more risk on that workforce housing, redevelopment play than you are on that luxury, core deal that relies on, jobs, wages, and things like that, not just based out of necessity. So it's kind of an interesting matrix of how it works.
Yes. Yes. Well said. Well said. Amy, what are your thoughts on this?
Yeah, I like what Jordan's saying. These are the deals that people think are a lot riskier. I think part of that perception of that is they're a little bit messier. The deals are they're not as pretty. An investor said to me recently, I want to see the pictures that I can show people. And, yes, we also want the deals to look really nice, but
Yes.
at the end of the day, we're looking to offer our tenants safe, affordable housing that, yes, they can feel proud to live in, that does feel good to call home, but we're not going to be the prettiest deals. And that doesn't make them riskier. They're just different. They're not the ones that you're not going to brag about the pictures to your friends. That's not this kind of deal. Because if it was this kind of deal, we wouldn't be able to attract tenants who need the housing at these certain prices to live in. It would go, the pricing would have to go over, or we wouldn't make any money. And I think the reason that we make more money in this particular asset class is because we have to micromanage it a little bit more. We have to really, like Jordan said, it's not the kind of thing you can check in on a monthly basis. You actually have to be there on a daily basis. You got to have a management team that is really on top of things, that's really helping the tenants through their daily needs in a little bit of a different way. And so they're not the sexiest deals. And so therefore people equate that to being a little bit riskier, but the returns are so different. It's like you can't even compare. I personally have no vision for A-class assets, so it's hard for me to understand. I would drown in that asset class. But we don't see this as a high-risk asset class when you actually look at the fact that the value of the buildings itself is inherently in the actual asset. And when you have an asset that is so far below replacement cost, your value is there. Now you've got to get the income churning to be able to support it, but the value is in that actual asset. So then it just becomes about those operations.
Yes, yes. And Jordan, what should investors be looking for in a sponsor or a fund manager when allocating capital here? What should they be looking for?
Experience in today's world, operating experience, and I think understanding their experience through their successes and their failures. I mean, I think often, a lot of the books that get sent out from, these sponsors or fund managers are all the success stories and hear how much money we made, but everybody will tell you all that. There are still going to be some failures. There's going to be some harder deals, and I think understanding how they navigated through those deals, because inevitably in real estate, not every single thing is always a home run. There's a lot of singles and doubles. So understanding that the person that you're partnering with is able to get through some of those devastating scenarios and still turn the deal into a single or a double, that's what really matters when it comes down to brass tacks on whether or not you want to be a partner with someone.
Sure, sure. How about you, Amy? Any thoughts here?
Yeah, I mean, it's you always want to be invested with the people who are specific experts in that specific asset class. Real estate is so broad. There's so many ways to make money in real estate, so many valid ways to make money in real estate.
Yes.
But you want to pick someone who's really focused on what they do and that particular area, because each asset class within real estate does function very differently.
Okay. And Amy, let me follow up with you. What are the biggest risks workforce housing investors face at this moment? And how are smart operators managing those risks?
I think it's understanding your particular tenant base. It's
Okay.
making sure that you're taking the preventative steps to where risks could be, which is, can your tenants pay the rent that they are signing up for, right? Are you running the proper background checks? Are you making sure you're checking people's employment? Are you staying on top of it to help remind your tenants that paying rent is going to be crucial on a regular basis? So kind of
Yes.
helping them manage and budget for rents that are going to get paid on a monthly basis. And then it's also making sure, the risk is also kind of letting communication falter. As soon as communication between tenants and landlords starts to waver, that's when you get tenants to stop paying rent or to move out. So I think the risk of poor communication, and I think that's something that a lot of landlords don't see as being crucial, but when you stop communicating, things start to fall apart. So I would say those are probably the biggest ones that come to
Makes sense. And how about you, Jordan? What are your thoughts on risks here to investors?
I would say more from like a valuation perspective, evaluating its costs, right? It's insurance, it's taxes, it's labor costs, it's material costs that have gone up that are outside of the investor's control.
Sure.
And so, mitigating that by proper underwriting, preparation, and planning for the deal is the only way around it. And I still think there's going to be a mass amount of success there, but really it's costs in the market, and that's what's driven a lot of people away from the market over the last 2 years.
Okay. And so, Jordan, if someone is investing in workforce housing today, what deal level characteristics should they prioritize for long-term durability?
I mean, location, right? It's always location, location, location in real estate. And a lot of that's going to be driven based on crime reports. I mean, I think that's an extremely important piece to be looking at.
Yes.
Average household income in the immediate area, like Amy just said, can the tenants afford the rents in the long haul after the renovation, et cetera? So, average household income, median household income in the area is extremely important. And then, where are the tenants working, and understanding where those job hubs are and where they're traveling to, and whether or not that's something that has long-term durability behind it. I would say, there's much more to talk about, but trying to hit location in three,
no, there's
I think
a lot of
those are
moving
probably
parts.
the three
Understood.
most.
How about you,
Yeah.
Amy? Any thoughts here?
Yeah, I mean, those are the things that we use to underwrite a submarket itself. Is what does employment look like? Is there a robust number of employers, but also different industries, so that you're not reliant on one particular industry to succeed in that market? We look back over a 10-year period to see the stability of a particular market. What does the population growth look like? Has that been stable? What has rent been doing over the last 10 years? What has employment been doing? What are what's the crime rates look like? What are the incomes look like? And then from the asset standpoint, is making sure we really understand what are the physical needs of the buildings.
And,
How are
and I want to follow up with you on a specific question. How do you analyze and determine the true reasons why people aren't paying rent? I mean, are you interviewing the tenants?
Yeah, we walk every single unit of every single building that we buy, and we try to talk to every single tenant that is home. And we literally will just ask them, why haven't you paid your rent? Or do you plan on paying your rent? And we'll get answers that range anywhere from, well, no one's fixed my leaking faucet for the last 6 months, or my toilet hasn't been working,
Right.
or my bathtub's been clogged up and no one fixes it. We'll get that. And we'll say to the tenants, well, if we can get that taken care of for you, would you pay your rent? And often the answer will be yes. Or we'll hear, nobody's in the office for me to go pay my rent to. I don't know who to pay my rent to. Or we'll hear, my neighbor stopped paying their rent and they never got evicted, so why am I going to pay my rent?
Right.
So that's what we try to really understand. Why are you not paying your rent? Or do you want to stay here in this property? And there's no wrong answer for us to hear. It's just a matter of us understanding, do we have the ability to make it right?
Yes.
Can we
And
get
Amy,
you to that next place?
I think both you and Jordan would agree that the returns on workforce housing are higher. So what do you have a target range for these deals, the deals that you get involved in? And if so,
Yeah.
what is that range?
Yeah, we want to be cash flowing in the low teens. So like anywhere from 10 to 15% is where we want to be cash flowing once we hit stabilization. That's kind of a broad range. So
Okay.
a little bit depends on the particular market. Um, we looking our for us, we're looking for approximately a 30% annualized return when we sell the property in about
Uh-huh.
3 years. So we're looking to like double our equity in 3 years. That's kind of what we're aiming for on a sale.
Yes. Very nice. Very nice. And Amy and Jordan, what what to what extent does what we'll call it political risk play a role in your decision making? You know, the municipality, the state, et cetera, et cetera. How important are those factors?
Yeah, it really depends on the submarket. So again, it comes back to communication. Communication is crucial. Communication with the city, communication
Right.
with the state, with the community, with all the stakeholders, the tenants, the the mayor's office, the police department, the code enforcement. But again, it's going to differ a lot state to state. When we're working in the South, the city doesn't always care what we do or how we do it.
Right.
And when we're working in states like New York, Illinois, we're working in DC, those are places that are going to micromanage what we do. And we can work in either of those places. We have portfolios in New York and DC and Illinois. I started my career in California. Those are kind of the hardest places to work, but it's really about the level of communication, where some of the easier states to work in require less communication, and the harder states to work in require the most communication. As long as you overly communicate, it's fine.
Okay.
It just takes more communication.
Okay. Thank you. Thank you. And Jordan, what are some of the underwriting adjustments you're seeing in today's market for workforce deals? What are some of those underwriting adjustments you're seeing?
Yeah, I mean, low rental growth, low to moderate rental growth with expenses generally outpacing income, which is a new shift over the last couple of years that have started to implement. Exit caps 100 to 150 bips over, purchase cap. I mean, obviously you're buying a distressed asset and you're buying a 3 cap, that doesn't hold up, but 100 to 150 bips over today's market cap rate, I guess I could say.
Okay.
And then we're seeing a lot of buyers come in and, stress DSCR on, year 3, debt service coverage ratios on year 3 at higher interest rates than what they are today after everything that we just went through. Basically just a lot of conservative nature coming from the buyer pool. Again, summarizing, rents to, expenses to debt service coverage ratios,
Okay.
et cetera, all much more conservative without a lot of natural rental growth.
Okay. And how about you, Amy? Any thoughts here?
Yeah. I mean, I think, I think Jordan's kind of, I would repeat what he's saying. I think we try to be very, very careful on the cap rates that we're underwriting for sales. So we try to overestimate what that cap rate's going to be. So we're looking to underwrite usually around a 7 cap
Okay.
on sale, even though we're usually selling below a 6 cap. We try to make sure that we're underwriting that really high just so that we can prepare for any sort of unexpected things
Sure.
that come up. So that's I think the most important thing that we look at on the
Okay.
back end of it.
Fair enough. And Amy, how do you source your deals? What criteria at a high level are you looking for? And is there a typical holding period that you target?
We're targeting a 3-year hold,
Uh-huh.
but we're finding things that we can create enough difference in that 3-year period of time. We also
I see.
underwrite for a 5-year hold. We want to make sure that we've got a really good A plan, B plan, and C plan, but our A plan is 3 years.
Okay.
We communicate regularly with brokers all over the country, trying to get everybody to send us the deals that they don't know what to do with. So Jordan will get regular calls from our office and saying, send us deals. What do you have that no one else is looking at right now? But really looking for things that aren't going to necessarily make sense to everybody, but where we could put our particular area of expertise into and kind of help get people out of messes that they're in.
Sounds good. Sounds good. Jordan, what about you? How do you source your deals?
Cold calling into the market. I mean, it's a little bit different now. After 10 years, we have a lot of relationships in the market, so our name gets us on the phone a little bit easier. But it's just reaching out to owners and trying to understand, what circumstance they're in with their asset, and whether or not we can provide some assistance. So a lot of it's cold calling into the market.
Good old spade work. I love it.
There you go.
Amy, how do you determine a fund structure, and what's your approach there? And would it be a fit for you and your legacy investors?
So, I mean, we try to find a structure that is pretty market. We want to fit in with everyone else. We don't really want to stand out as being anything we don't want to charge fees that are over market. I would say one big difference on us is we don't like to take acquisition fees. We try to stay aligned with our investors as far as we want to make the most money if the deal makes the most money on the sale and not
Yes.
so much on that acquisition. So otherwise, we try to maintain a deal structure that's pretty similar to other investors. An 80-20 split
Fair
usually
enough.
is what we're looking at, and anywhere from a 1.5% to 2% asset management fee is usually what we're looking at.
And Amy, let me just follow up on something you said a moment ago. We talked about hold period. You as well, Jordan. Does the 3-year hold, okay, allow for earlier investor distributions?
So yeah, we typically have a fund lifespan that is a little bit shorter than most other real estate companies. So we're looking at like a 3-year investment period and then 3 years of disposition. And we start our dispositions in that as soon as our first deal is done. So we've got like 3 years of purchasing, but then we start returning returns to our investors right as we start to sell, which is about that 3-year mark. So we have our fund models on a 6-year fund hold.
Fair enough. And my final question: you're scaling up quite a bit from your first fund. How is your strategy shifting, if at all?
Our strategy is exactly the same as it has been. We really like what we buy. We like what we do. We don't want to shift that. I think what we found before is that there were just too many deals that we had to pass on. Or we had to kind of really make sure that we were carefully spreading out over time, but it meant that we were not able to buy everything that we wanted to buy. And so we just wanted to increase that size a little bit for our last fund. It was a 3-year investment period, but we were done in less than 2 years. And so we want to make sure that we have enough to keep going. And so that
Fair
was
enough.